that's there. Okay. Any questions before we get started? No? Okay, so let's go ahead and let's start in on Chapter 3. Okay, we're talking about early stages of the engagement. Okay, so we're going to talk about client acceptance. We're going to talk about preliminary engagement activities, which is going to include talking to the predecessor auditor. Predecessor auditor is the auditor who audited last year's statements. We're going to see that there's a requirement that we speak to that predecessor auditor, and then planning the audit at very, very high levels here. Okay, guys, sorry for all the technical stuff here. I just want to make sure, because I'm somehow having this weird feeling that it's not recording the audio. Check 1, 2. Looks like it is, though. Okay, so I'll just live with it. Okay, I'll just accept that it's working. Okay, so client acceptance. Okay, and we're going to see that one step that we're going to have to do is inquire of third parties before we accept this engagement. Now, the primary third party is going to be the predecessor auditor. Those are the individuals that audited, say, last year. So if I steal the client away from you, you become the predecessor, I become the successor. And there's a requirement that the successor talk to that predecessor auditor. We're literally going to have specific inquiries. Okay? Now, we're also going to want to understand if the firm is independent and if we have the adequate skills necessary to complete the engagement. Okay? So what we're really looking for here are there reasons that we should not accept this client. Okay? So what I'm going to give you is a top 4 reasons not to accept a client. Okay? It's top 4 reasons not to accept a client. Okay? And I'll just go from the bottom up. Number 4 is lack of firm ability. Lack of firm ability to serve his client. Remember, guys, my writing is not good, so I'll always read those out to you. Lack of firm ability to service the client. Okay? If I have a one-person firm, can I audit GM? No, it's too big of an entity for me to be able to audit it, right? So I need the sufficient training, the sufficient size of the firm, etc., to be able to properly do that. Okay, that would be the number 4 reason not to accept a client. Number 3 reason not to accept a client is client lacks sufficient records. Client lacks sufficient records. Number 3 reason not to accept a client is client lacks sufficient records. So, can I audit a shoebox? No. Remember I said, hey, if I can't reconcile the financial statements to the ledgers and all that and tell them, well, buy, then you guys got to figure all this out because I can't sit here and put together the financial statements for you. Okay, so the client has to have the sufficient accounting system, etc., for me to be able to successfully complete this audit. Number 3 reason not to accept a client. Okay, the number 2 reason not to accept a client, and I'll put this over here, is management lacks integrity. Management lacks integrity. If management lacks integrity, we're going to see that the standards are going to tell us to step away from the audit. Do not accept a client in which the management lacks integrity because they're only going to bring you down with them. Okay? Probably Anderson wishes they are they're up in heaven now, saying we wish we had listened to that and not accepted the client whose management lacked integrity, or got rid of them once we realized that they lacked integrity. Okay? And then the number one reason not to accept a client, an audit client, is lack of independence. You can see that up in the slide there. Okay, lack of independence. I don't have independence. I cannot accept that audit client. I must be independent. So I can't audit my mother's bakery, my father's jewelry shop, whatever. I have to be independent of that client. Okay? So these are the top 4 reasons. Now when we look at some of the questions a little bit later, you're going to see that the one you see coming up again in the literature is that management lacks integrity, because everybody knows you're not supposed to accept a client that way. You're not independent, and so a lot of the questions don't focus on that because it's too easy. Management lacks integrity is the one you see more in the questions. Okay? But if the firm doesn't have the ability, the client doesn't have the sufficient records, management lacks integrity, or we lack independence, we cannot accept that client. Okay? Question? If management lacks integrity, third party, inquire third parties regarding client integrity. Okay, so we're going to have to ask the predecessor auditor, and you'll see that the questions that we're going to ask them start to center all around management's integrity. Okay, you could do something like look at their credit ratings, all of these different things that start to give you, and it's not like there's some, God doesn't come down and say, hey, you mess with these people. At some point, your spidey senses start to tingle and say, I think I better stay away from this particular client. And so it's more of an art, it's more of a seance than it is a very scientific type of stuff. Okay, so communication with the predecessor. Okay, and the predecessor is the one who had audited the previous year. We would be the successor if we were taking over this client, okay, from one year to the next. Sometimes there may be a change in auditors. And in an initial audit, it is mandatory that we make inquiries to the predecessor. We must talk to them. Client permission is needed, however. Now, when I was studying auditing, that's the kind of stuff that used to drive me nuts, because I'd be like, well, if it's mandatory, why do I have to ask the client permission? Don't I have to do it? Well, there could be rare extenuating circumstances in which you would not want to talk to the predecessor. For example, maybe the client, the potential client, and the predecessor are engaged in some sort of litigation, and the predecessor, the potential client is saying to you, hey, you're going to buy us our case, and you sit down and you listen, and it seems like you have a reasonable position, then maybe you wouldn't do this otherwise presumably mandatory requirement, which is to talk to the predecessor. But be careful. If you're in litigation with the predecessor, you may be next, right? Okay, so you need the client permission to go ahead and have that meeting. But if the client with the predecessor, but if the client says no, be very careful about still being willing to accept that engagement, because maybe there are some problems there, right? But you could get around that, okay? Now, the inquiries that we're going to make could be written or they could be oral. And we make these inquiries, guys, before accepting the client. So you're going to have this meeting, even though you're going to ask the client to set the meeting up for you. You're going to have this meeting with the predecessor, and you have to ask these questions before you can accept the client. Okay? And let's see what the nature of these questions are. And we're going to see that they are very much geared around what? Management integrity. Okay, so let's just take a look at some of these. So, information that might bear on management integrity. Okay, well, that one's clearly in the integrity camp. Disagreements with management over accounting principles, procedures. If the what is the predecessor's understanding for the reason for the change? Okay, the predecessor may say, well, look, we had certain things that we felt that they should be doing for the financial statements. We wanted to qualify our opinion. We couldn't agree, and they just decided to show us the door, right? Well, that may be a client that you don't want to get involved with, because remember, our number one reason not to accept a client is that management lacks integrity, right? So you can see how these questions are angling to us what? Communication and management, audit committee, those charged with governance regarding what? Fraud, non-compliance with laws and regulations. Okay, so you can see that what we're gearing around. Did they commit some sort of fraud? Are they not in compliance with laws? Again, trying to get around that management integrity. Okay, good. Any question? Okay, again, these inquiries must be made before you can accept that client. Okay, good. Then you come over. Let's see, come over. Really. We're going to do this. Okay. It was working a minute ago, wasn't it? Why? Okay, it's going to be one of those days. Okay, now, client retention. After you have accepted the client, you need to periodically review the client for retention. Okay, are we going to keep that client? Okay, and now we don't have to, inquire of a predecessor. Now we're going to have what? Direct knowledge about any conflicts, if there are any disputes about fees, that sort of thing. That's all going to be something that we're going to be in direct knowledge of. Okay. Taking a look, determine the audit team requirements, and assess compliance with ethical and independence requirements. Again, we have to make sure that we're independent, that the staff we assign are independent. That is necessarily the number one reason not to accept a client. Okay? Now, we are going to have an engagement letter. Okay? There must be a written engagement letter on every audit. Okay, so why don't you go ahead and put that in, but that has to be written. Have to write written. Has to be written. There must be an engagement letter. Okay? And it's going to have the objectives of the engagement, management's responsibilities, and the auditor's responsibility, and then the limitations of the engagement. Okay, so if you look, there's two responsibility ones, and there's two what? There's two that are describing the nature of the engagement. Okay, management responsibilities, auditor's responsibilities. What is the objective of the engagement? What are the limitations of the engagement? Okay, so if you take a look, you can see that I give you a slide in which I give you how to remember management's responsibility and auditor's responsibility. Okay, and guys, I'm not the best mnemonic guy. Okay, so this is Chris Porta. and I'm not sure what that means, okay, other than maybe like a crisp quart line of some sort, but quart lines aren't supposed to be crisp, are they? So anyway, but this might be some way of remembering, okay, some of the key management responsibility things. Auditor's responsibility. It is management's responsibility to identify the applicable framework. Okay, management identifies that applicable framework, U.S. GAAP, IFRS, whatever it is. Okay, providing management representation letter at the end of the engagement. Now, it turns out that auditors are lonely people. And so what they want to do is they want to send letters to people and get letters back. So we arranged to get a letter back from management at the end of this engagement, and that is called a management representation letter. So at the beginning of the engagement, we will have the engagement. And under management's responsibility, we're going to point to a letter that we will get at the end of the audit. And that letter at the end of the audit is called the management rep letter. We're going to talk about this more in much later chapter when we talk about wrapping up an engagement. But when we talk about the management rep letter, it has in here things like liabilities are complete. Assets exist. If there was any fraud, they told us about it. If there was any illegal acts, they told us about it. If there were misstatements in the financial statements, they told us about it. Okay? Now when you look at this management rep letter is going to be signed by the CEO, CFO, high-level individuals in the company. It's not signed by, the housekeeping staff. Okay, it's signed by high-level individuals in the company that are going to, and if you really look at this letter, they're going to give us information that is hard for us to audit. Management's intent. How do we account for held and maturity securities? How do you account for held and maturity securities? These days, nobody teaches that. These days, you would send a confirmation to a broker like Charles Schwab or somebody like that, saying, do you hold investments in the name of my clients? You hold stocks, let's say, in the name of my client for XYZ company. So I'm auditing Gatorade, and Gatorade has stocks in Apple, and those stocks are being accounted for, say, Charles Schwab. And Schwab will say, yes, Gatorade has, 5,000 shares of Apple stock, and that's how I'll confirm that those stocks actually exist. Stocks rarely exist in a hard copy form anymore. The only time I've heard of them existing in hard copy form is if you hold investments in, say, a foreign company. It still does things the old-fashioned way, but these days in the U.S., everything is book entry system. Okay, but if we're talking about, say, bonds, in order for us to count for that as a held and maturity security, management has to have a positive intent and ability to hold that to maturity, don't they? How do you audit management's intent? When are you going to sit there and put the thing on, okay, what are your intentions? Okay, so we'll take it to your ear. I mean, you can't read their minds, right? So we make them put in this management rep letter that the securities that they have held in maturity, that they intend to hold them to maturity, right? And they can put it down in writing and then sign it at the end of the audit, okay? So if you look at this list, what this management rep letter is trying to do is get us evidence on things that are hard to audit. It is hard to be sure that we detected fraud because look, people are trying to hide it from us, aren't they? So what do? We put in the management rep letter, hey, you told us about the fraud, right? Okay? Completeness. Liabilities are complete. Completeness is the harder assertion to audit, even though I put assets exist up there. We're more concerned about completeness of information because what happens? Existence is an easy little assertion to audit. I see something on the financial statements, I go over it and I find it. There it is. See how easy that is? Completeness, there's a whole world out there that maybe should be in the financial statements and I gotta figure out, did it hit the financials, right? So what do? I cover myself by making the CEO, CFO, put in the letter A. Liabilities are complete. We gave you all the books and records, and we go on and on about complete. Okay, the rep letter. Now we're going to have a full discussion of management rep letter later, but it's a pretty important piece of audit evidence, isn't it? It is, in fact, is mandatory that we get this management rep letter at the end of the engagement. So imagine if you went through the whole audit, you got to the end, you said, hey, sign the management rep letter. They said no. That would be a problem, wouldn't it? Now we've expended all these resources and we can't get a piece of evidence we need to finish the audit. So we would hold up the engagement letter, which is a contract between the auditor and management, and say, remember this thing you signed at the beginning and you said you were going to give this to us? So if you don't give it to us, we're not issuing you the opinion, and here's our bill. Please pay under the terms of the contract, right? And that has an interesting way of motivating people to do what you want. Okay? So we cover ourselves by what? Calling out that management rep letter in the engagement letter. Information that the auditor will need about subsequent events. Subsequent events are events that happen after we are ready to, after the date of the financial statements, but before we issue our report. And we'll talk about subsequent events a little bit later. Do we need any specialists? The arrangement, and we'll talk about specialists here a little bit later, or internal auditors. We may use the internal audit staff of the client. Okay? And then, again, we need to meet with those predecessors, so we'll want them to, agree that they're going to help us along with that. Auditor's responsibility, we have to plan and perform the audit. We have to provide documentation to other parties. If there's other auditors involved in, say, auditing a subsidiary, it would be part of our responsibility to make sure that those other auditors are receiving the information they need. If there's any restrictions on our liabilities, okay, arrangements regarding the compensation of the engagement team, and we will always call out in our engagement letter if we're going to have a report and the form and content of that report. I'm going to call that out. Some engagements don't require a report. We always talk about reporting requirements in our engagement letters, whether we're going to issue a report or not. Okay? Okay, good. So here's a couple questions. True or false, audit fees and costs should not be discussed in the engagement letter. That is false. It is a contract, and we want to get in there what our fees are going to be, any reimbursements for travel, etc. That would be an engagement letter. True or false, all audit engagements are to have a written engagement letter. That is what? That is true. Have to have a written engagement letter. Okay? Okay, good. Which of the following generally is included in an auditor's engagement letter? Management's responsibility. We had a whole slide on management responsibility for the applicable framework and the fair presentation of information. Okay, good. But let's look at these others. The factors to be considered in setting preliminary judgments about materiality. Look, we don't want to put management to sleep here in there. I mean, we will be making preliminary judgments about materiality, but we're not going to be putting it on the engagement letter for management to read about. That's something that the auditor will handle, right? Okay. C, management's vicarious liability for violations of laws and regulations committed by its employees. Come on, that's not something you're going to put in an engagement letter. And management may have some sort of vicarious liability. Vicarious meaning that what? If some of the employees commit some sort of improper act or something, it could come back on the company, right? Okay, but okay, put that in the engagement letter. The auditor's responsibility to search for significant internal control deficiencies. Hardy, har. We are not looking at internal control to search for deficiencies. We are looking at internal control to help us to determine the timing and extended nature of our audit procedures. There is no searching for significant internal control. Okay, so the clear thing here is more responsible for the financial situation. Okay, good. Now, engagement letters. Okay, in addition to some of the things that we saw, and there's an exhibit in the book that talks about the engagement letter. If we're going to be using specialists, limitations of liability, additional services, arrangements regarding other services, sort of miscellaneous catch-all things. I think we got some of the big ones on this that Chris worked our slide. Okay. All right, let's talk about the internal auditors then. Okay, and we can utilize the internal auditors. Okay, and when we look at the internal auditors, we look to their objectivity. Okay, we're going to look to their objectivity and their independence. Objectivity and independence. Okay, key to their objectivity is to the level of the organization they report. So the internal auditors should report directly to the board of directors. Now, sometimes you'll see an organization chart in a client, and you'll see a dotted line to the CFO, and you're like, why do they have that dotted line? It doesn't mean that that has to go like this and go talk to the CFO. It means that board of directors do not have the ability to pay. So administratively, you'll probably report to the CFO, but functionally, you report directly, he or she reports directly to the board of directors. Okay? And what the internal auditors are doing is they're looking at the internal controls of the company to see if they're achieving the desired objective, right? So it would be very useful for the auditor to what? To maybe get some documentation as to how the internal controls work, what have been some problems, what sort of work do you do as part of your overall overseeing of the internal controls, right? And so that helps with the objectivity. Competence is what? Whether they have adequate technical training, proficiency. Okay, would you trust a internal auditor that has passed the CPA exam? They have a CPA. Yeah, I'm going to be much more comfortable with the CPA because they're going to be very good competence, right? Okay. Now, we cannot share judgments with the internal auditors. Okay, so do not share judgments with the internal auditors. Do not share judgments. Do not share judgments with the internal auditors. Do not share judgments with the internal auditors. For example, can the internal auditors assess control risk for us? Can the internal auditors say, oh yeah, the control risk here is low? That's an auditor judgment, isn't it? We don't share that with the internal auditors. We don't share our judgments. Okay? Can we share our assessment of inherent risk? We'll talk about that. The answer is no. Any assessments, decisions about materiality, all of these things, you don't share those judgments with the internal auditors. That is the purview of what? The external independent auditor only, right? Okay, but you can use them to help you understand the internal controls, maybe to help you do some routine tasks, like put together depreciation schedules, that sort of thing, right? There's no reason to do that. Of course, that will be talked about in the engagement letter. Okay? So, for which of the following judgments may we share responsibility? No. You do not share responsibility, right? You do not share judgment with the internal auditors. And that's an easy question to miss, because ever since you were 2, they've been telling you to share, haven't they? Share. You see the word sharing. Oh, yes. And it's also sharing is good. Sharing is bad when it comes to sharing our judgment with internal auditors. Okay, good. Audit committee. Okay, it is a subcommittee of the board of directors. And Sarbanes-Oxley came in, section 301, and said that we have to have an audit committee with a public company, and the members of the audit committee need to be independent, directly responsible for overseeing the work of the audit, must approve all audit and non-audit services provided by the auditors. Okay, and this is very important in that we don't want situations where management is going and what? Engaging with other CPAs for different things, and the board of directors have no idea as to what's going on. So the board of directors need to approve all audit, all non-audit services. They need to be in the loop about all of this. Okay? Okay, good. Planning the audit. We're going to develop an overall audit strategy. Okay, and in that overall audit strategy, we will make preliminary judgments about materiality. And we're going to talk about materiality at the end of this chapter, but we will be making preliminary judgments about materiality. Now, materiality is something that is adjusted as the audit goes on, but in the early stages, when we're planning the audit, we will be making preliminary decisions about materiality. Okay. Now, we will also have a written audit plan, must be written. We will have a written audit plan that's going to be more detailed than the strategy, in which we're going to have some very basic preliminary judgments about things like materiality. Okay? It will literally go by a financial statement assertion and call out the different things that we're going to do to handle the different assertions. Remember, we always audit to the assertions, right? Okay. Okay, good. Now we're going to assess the entity's business and its transactions. Okay. And we're going to identify financial accounts likely to contain errors. Okay, and we will either do this because of previous experience with the client, previous experience with the business, or we will absolutely do a set of analytical procedures that will point out accounts that have more risk for material misstatement to us, and of course we will then cast our audit scrutiny on those potential accounts that are more risky. So that's why, this guy is, I don't know what's going on with his eyes, but that's why he's looking at a particular account that's more susceptible to error. More risky accounts we're going to look at. We need to understand something about related parties. Now first, let me ask you, is it okay for an entity to have transactions with parties that are related? Yeah, it's okay. You can have transactions with subsidiaries, that sort of thing, entities related to, right? But related party transactions have to be what? Have to be properly disclosed. Okay, so if there are transactions with principal owners of another enterprise, management, immediate family members, these have to be what? These have to be properly disclosed. So, have to be disclosed. Okay, so the investors know. So we'll disclose those related party transactions in the footnotes and stuff. So how would you find out if there's a related party transaction? If there is one, you want it to be disclosed, right? How would you find out if there's a related party transaction? Huh? Yeah, very good. You say, hey, management, give me a list of related parties whom you had transactions with. So then what? Then, when I'm, say, auditing accounts payable, and I'm looking at the sample transactions that constitute accounts payable, I will look to the related party listing and see if there are any transactions with those entities that are listed as related parties, and if they are, then I'm going to look to see that they're properly disclosed, right? What happens if I'm auditing the accounts payable, I see a transaction, I look to the related party listing that management gave me, and I don't see that entity there, and it turns out that it is a related party? How happy is the auditor? Not too happy, because there's no reason why management shouldn't have known who their related parties were and whether or not they had transactions with them. So I start getting a little bit nervous at that point, because I would want to know, why wasn't that particular entity included on the related parties? Okay. You can also look for unusual transactions. For example, let's say there was a loan, and the loan was made at significantly low interest rate, non-market terms. You might start to say, why are you giving money away? What's going on here, right? And, it turns out it was a loan that we guaranteed, or that we were helping out because there was some related parties. Okay, so it's okay to have related party transactions with these different entities, but they have to be what? Properly disclosed. And you ask management early on in the engagement to give you a listing of the related parties as part of your planning process, so you have those and you go ahead and you start to do your detailed audit work. Okay? Now, when we have consolidated financial statements, we may need to look at, we will need to have some involvement with what? Subsidiaries. Okay, so we're having a consolidated financial statement audit, and we're going to have to do some work with the subsidiaries, right? Let's say this consolidated financial statement has 10 subsidiaries. Which subsidiaries are you going to look at? Which subsidiaries, I should say, look at? You can do some work with all of them. But which subsidiaries would be more significant amounts of risk? High risk ones. Good. So if there's a subsidiary that has what? Transactions that could be fairly complex, or maybe are significant from a dollar standpoint, the big ones, you look at those, very good. If you have what? If you have some that are smaller, lower risk, it doesn't mean you ignore them. It simply means that what? You're not going to be doing as much work with those procedures, right? So you can probably do some very quick analytical procedures over your lower risk subsidiaries. Your higher risk subsidiaries, those with larger transactions. So you look at them both from the standpoint of how do they impact your materiality, how do they impact your audit risk. So those are the two things. Okay, need for specialists. First of all, Who's a specialist? An expert in the field, and from our standpoint, other than accounting and auditing, we are the specialists in accounting and auditing. So we're not looking for specialists that help us out with accounting. We're looking for specialists that will help us in an area that we're not well versed in. Okay? For example, I was on audit of U.S. Forest Service. And on the audit U.S. Forest Service, the way the Forest Service reports its inventory is in board feet of lumber. So we say, okay, let's see your inventory. And we walk out into the forest and they say, there it is. How do I know how many board feet of lumber are in a forest? Okay, so what do? You go and you use what they call a silviculturist that is able to look at the general health condition, size of the trees, etc., and give you a reading on how much board feet of lumber there is in the forest, right? Okay, so it's areas like that where we may want to bring in a specialist, or maybe we have a particularly complicated IT system, etc. We'll bring in specialists for that. Okay, maybe we're auditing a jewelry shop. How do I know if it's cubic zirconia or whatever in there, or really, I diamonds or whatever? So what do? I bring in a specialist for those kinds of things. Okay? Okay, good. Now, when we look at what we're supposed to do with specialists, we are going to be interested in their competence and their objectivity. Does that sound familiar? Same thing that we said for the internal auditors, right? We're interested in their competence and objectivity. Now, we say that generally that a specialist that is unrelated to the client will give us the higher level of objectivity. However, a specialist that is related to the client is okay in some circumstances, but we may want to provide additional procedures to make sure we're satisfied with their objectivity. Now remember, we have our auditing standards board, and our auditing standards board does what? Our auditing standards board is practicing auditors. They come in from time to time to write the standards, right? And remember I said they're going to tell you what should be, but then they're going to tell you what can be. Okay, what happens? I'm in the middle of a forest. I'm going to find a bear before I find another silviculturist that I could use that would provide objectivity. So it's okay to use the silviculturist that's on site at that point in time, just as long as you get satisfied with their maintaining their objectivity. Okay? Now, we have to agree in writing with the specialist as to what the objectives of the work are, the roles and the responsibility of each, the auditor and the specialist, and if there are any confidentiality requirements, what are they? Okay, but we're going to have a written agreement with the specialist. Now, what is the impact of a specialist on the auditor's report? Okay, if the specialist finding indicate that the financial statements are not in accordance with GAAP, then we will call out that specialist when we issue our opinion. Okay. Now, if as a result of the work performed by the specialist, we have to modify our opinion, we'll refer to the specialist. Okay. If we're giving an unmodified, unqualified opinion, no reference to the specialist should be made. Okay. So, we haven't talked about qualified, unmodified, etc. yet. Okay. So just know that the only time we call out the specialist in our report is if there's a problem. The specialist says, no, they haven't valued that art correctly. Then we're going to call out the specialist. If the specialist says, yeah, okay, everything's fine, we write our report, we don't mention the specialist. We only mention if the specialist finds something wrong. Okay? Okay, good. When auditing Vandali jewelry, Constance CPA was not familiar with the quality and cut of the company's precious jewelry inventory. To address this shortcoming, Constance hired an expert in jewel valuation to assist as an audit specialist for the inventory valuation. Should Constance refer to Deanie's work in the audit report? And the answer is only if there's a problem, right? Okay, so the use of the audit specialist need not be mentioned. The auditors, if the auditors decide not to take responsibility for the auditor specialist findings. I mean, guys, some of these questions, you know, are the way the choices are the way auditors would talk after their third being audit. You gotta keep them sitting going, what did you just say? I don't understand anything you just said. Cut the gun off. Okay? Alright. Second one, B, the auditor's report should mention the use of audit specialists only when the audit specialist findings affects the auditor's conclusion. Right? If there's some problem, we're going to mention the specialist. The auditor's report should mention the auditor specialist only if Validay agrees with the audit specialist finding. Well, why do we need the specialist if we're in position to agree or disagree with their findings? I mean, I'm assuming we're going to take their work, we're satisfied with their objectivity and their competence. That's why we have them there, right? Is to give us the information we need. So we're not going to say, well, we don't agree. You know, we don't think you valued those correctly. Well, why am I here then? That's the specialist. Okay? Yes, the auditor's report should mention the fact that the audit specialist is used only if what? Only if there's a problem. Right? The auditor should understand the specialist procedures. Okay, that doesn't mean that we have to become the specialist, but we should be confident enough to understand the nature of the specialist procedures and be satisfied that they're doing the things that they should be doing. Okay, so again, you know, you don't have to become a surgeon to, you know, do that, but you should understand the nature of the work, etc., and be able to do that enough in order to be able to understand what the specialist has done. At the same time, we are responsible for educating the specialists as to what our needs are here, right? So there's a meeting of the minds of the professionals, okay, to be able to come up with the answer. I was on an engagement where Congress wanted us to try to estimate the number of retirees who could potentially lose their benefits because they tapped out essentially and buying insurance annuities for them. And so what I did, I still remember, was pretty good. And we were having trouble getting a handle on exactly how the Department of Labor came up with their estimate and the pensions and whatnot. And so there was this guy, Jack Early. He's gone on with a big audit of the stock. Jack Early is very trusty auditor. You're going to get on an airplane, and you're going to go sit down and talk to the Department of Labor until you understand how they came up with that. I don't care how long you have to be. So, get on a plane, go to Washington, I sat down with an economist for the Department of Labor who's responsible for putting together some of these estimates until I got a handle on how he was doing that. And at the same time, I was, you know, educating him on what our purposes were and why we needed that information, and we were able to put together an estimate that way as to how many retirees that were potentially being exposed to losing the benefits. So there's times when you do those kinds of things. You explain them, they explain to you. And through that process, you get a sense as to the confidence level. Okay, supervision of the audit, okay, and we are responsible for making sure the team knows what their responsibilities are. By the way, when we talk about supervision in the audit standards, we are typically talking about the partner. At the end of the day, the partner is the one who is responsible for the outcome of the audit. Okay? So when we talk about supervision, we're talking about the partner. Now that doesn't mean that you don't have senior managers who are involved in line and managers that are in line. Yes, there will be delegated authority, but at the end of the day, as far as the standards are concerned, the partner is the one who is responsible for the steps we're talking about for supervision, making sure that all of the engagement team understands their requirements, that there's adequate review of their work, etc. Supervision. Okay. Okay, good. Any questions? We're going to kind of shift in different directions here. We're talking about some preliminary planning stuff, right? There's two key ones there. Using what? Using the independent auditors, using what? The specialists, and then the other thing, what? The requirements for our engagement letter. Probably we maybe take away from that section. Okay. So what we're going to do now is turn our attention back to the assertions. And we've already talked about these assertions to a certain extent, so I'm going to go pretty quickly, I think, through some of this. Remember, we have transactions and events is a category of assertion. And remember, I think we said last time, these are what? Current year journals. Right? We have account balances. That's going to be what? All years ledgers. Okay, so when we're looking at transactions and events, that's the current year. That's the sales journal, that sort of thing, right? Okay, when we talk about our account balances, if we bought some equipment 5 years ago, the equipment has a 20-year life, we would still want to check to see that the equipment is still here, right? See that it exists, etc. Presentation and disclosure are going to be what? Our footnotes. Remember we talked about all that last time? Okay. Now, when we look, notice that we have our 5 main assertions. We have completeness. We have existence, which those are like the 2 main assertions that we talk about quite a bit. Completeness, existence. We know to audit completeness, we do what? We go from the supporting documentation back to the financial statements. For existence, we go from the financial statements to the supporting documentation, or the actual physical manifestation. We have what? We have cutoff. Now remember, the AICPA calls out cutoff because they want us to make sure and look at transactions close to the year end and close to the beginning of the next year to make sure that they've been included in the correct period. Whereas PCAOB doesn't call out cutoff because they look at it and say, hey, if you've tested existence, you've tested completeness, then you've tested cutoff. But AICPA looks at it a little bit different and say, okay, but we're going to call it cutoff because we want to make sure that you look at the transactions close to the year end and close to the start of this year, right? Okay. Rights and obligations. Remember we talked about that. Just because you have a particular asset doesn't mean you have the right to it. There could be a lien, etc., on those particular assets. Valuation. Remember we said that what? Valuation deals quite a bit with estimates. Do we really know that we value the account receivable correctly? No, and after some estimate the collectability stuff, right? Okay. And then understandability and classification really is dealing with our footnotes. So we talked about these assertions last time. Okay. Now, notice that if we're talking about existence, if we're talking about existence, notice we're going to, and let's just do it this way. I'm not sure that I'm in love with this graphic. We'll start with the financial statements. And we'll find the supporting docs. That's going to be existence, isn't it? If we start with supporting docs, and come back to the financial statements, that's what? That's completeness, isn't it? Okay? So, depends on where you start. You start with the financial statements, go to supporting documents, existence. You do what? You start with the supporting documents, back to the financial statements, that's completeness. We talked about that our first day, right? In first class. Now, this particular slide is using a couple of words, trace and vouch. So you vouch for existence and you trace for completeness. But be careful, guys, because not everyone sits there and says, oh, yeah, trace for completeness, vouch for existence. Sometimes somebody will say trace, and they really want you to do an existence test. Okay, so don't memorize the word trace and vouch. Know what you're doing. Okay, if you're trying to test the existence assertion, you find the item in the financial statements, the subsidiary ledger, whatever, you walk the floor and you go find the thing, right? Or you send out a confirmation in the account receivable. You pull a sample of accounts receivable, you send out a letter to those individuals saying, do you owe? Right? That is existence. Completeness is doing what? Taking the shipping documents, taking the invoices and what? Finding them back in finance. Right? Notice I didn't use the word trace or vouch there to describe the procedure. Okay, now, this slide is beautiful. This is a beautiful slide because this is the way we need to start thinking about all of this stuff, guys. We're going to see that we're going to go chapter by chapter with audit procedures, and we're going to call them out for this account, that account, and your head's going to start to spin. You're going to start to say, how do I remember what procedure I'm supposed to do for inventory? What procedure am I supposed to do for equipment? Oh, what am I supposed to do for investments? And you start to get all, that's how you start to get into, I'm not sure I got to go find you guys the box, right? Because I'm investing investments, right? And you kind of end up that way because we're going to sit here and pepper you with all these procedures, okay? And what I want you to do is I want you to get in a mode where you think about what assertion am I auditing? If you don't know what assertion you're auditing, you have no business doing that audit procedure, okay? So the reason, being the one that's conducting that audit procedure, is a little bit cut off here on the screen, but that's his audit procedure at the top. And notice the audit procedures are lined up on this slide with what? With the assertions, aren't they? Okay, so notice that for existence, we say what? We're going to go from the financial statements back to the supporting documentation, okay? Which is what confirmation does. Confirmation pulls a sample of accounts receivable from my client's subsidiary ledger and says, hey, are you out there? Hello, hello. Do you owe some money, right? Okay, so confirmation is the classic existence step. Completeness, now we're going to do what? Start from the source document and then go to see that it's recorded in the financial statements, just like that picture we looked at earlier. Okay? When you deal with valuation allocation, guys, these are accounting estimates. I don't understand why PowerPoint doesn't have, if I'm in Word or if I'm in Excel, they give me a little set of pens up there to choose from. Why in PowerPoint do they not give me those little pens up there, which is probably where you're going to be doing more of the writing on a document as you go along. But anyway, so valuation allocation, these guys are accounting estimates. Do we have responsibility for making sure that the estimates that are in the financial statements are reasonable? It's in the opinion, right? And the estimates made by management are reasonable. We say that in our opinion, don't we? So the best way to make sure if an estimate is reasonable is to recalculate. See if you agree with what they came up with in the estimate. Okay, they did an aging of their account receivable. Based on an aging of their account receivable, they said this was the amount that should be uncollectible. Is that reasonable? Is it reasonable that if a receivable is 120 days past due that they should only put 1% in the allowance for that? No. We're thinking the percentage has to be higher, right? Unless they can demonstrate that somehow after 120 days past due they end up collecting on this, right? We would be looking to see what's reasonable, right? Okay. You take a look. Understandability, classification. These are the disclosures, footnote disclosures, cutoff procedures, before and after year end, right? And I gave you some examples of steps that you would do before and after year end last time or a couple times ago. Before year end, I'm doing what? I'm looking at what a shipment that was made before year end, and I'm looking at the shipping terms. There's free on board shipping point, and I have a sale. There's free on board destination, I don't have a sale. The after year end, I was looking at the sequence of the shipping orders to make sure they were all there, the shipping documents to make sure they were all there, all the sales orders, etc. Okay, now we'll talk about all of these more in detail as they relate to specific accounts as we go along through the course, but I always want you to come back. I don't know if you have to come back to this specific slide, but I always want you to come back to your understanding of this slide and how you audited the assertions generically. And the more and more comfortable you get with this, the better and better of an auditor you become. Okay? All right, good. Now, we are going to be assessing our risk. So, let's say, we're going to be assessing our risk, and we're going to be assessing our risk at two levels. One level is our overall financial statement risk. The other is going to be an assertion-specific risk. Now, when we look at our overall financial statement risk, we respond at a very general high level. Okay? So who wants to become part of this? Who wants to be a part of this? Congratulations. You are a brand new partner in the CPA firm. And I'm telling you that you have a client that has a high overall financial statement risk. Ready so far? When you assign staff to that job, are you going to assign staff with more experience or less experience? More experience. Are you going to assign a manager who's going to get a little bit more in your face kind of manager that's going to stay on management, say, hey, give me the documentation, or are you going to maybe put someone who's a little shy? A little more in your face. Good. Are you going to visit that audit site more or less? You're going to visit that audit site more. Did I pick the right guy for partner? Okay. Well, he volunteered, but what? You're going to sit there and you're going to assign what? More experienced staff. You're going to increase your level of supervision. Maybe you're going to do a surprise inventory count or something like that, right? Okay, very good. Okay, so we're responding at a high general level there, aren't we? But we also have to assess our risk at the assertion level. So we're going to assess our risk and ask ourselves, what could go wrong at the assertion level? So what's something that could go wrong in the existence assertion for say input? What's something that could go wrong? Yes. Let's say the existence assertion for input. It's not there. That's wrong. That's not good. They listed something on the financial statements, and when we went to find it, it's not there. That's bad, isn't it? So we literally are going to have to assess the risk that that bad thing can happen. And based on our assessment of that risk that that bad thing can happen, we will then determine what audit procedures we have to perform so that we will catch that bad thing. And we will do that for every assertion. Now, what increases the chances that a bad thing will happen? Good. Exactly. They don't have the appropriate internal controls to prevent or detect that bad thing from happening, right? So that's why we're going to look at the internal controls, not because we're sitting there searching for internal control weaknesses and all that stuff, because we want to understand how effective are those internal controls at preventing and detecting that bad thing from happening in the what? Assertion. So we try to line up controls that are good at what? Blocking the bad thing from hitting the financial statements, right? Forgive me, guys, I like sports. I've seen football before, right? And what happens? They have some really big guys that sit there and block really other big guys, because big guys are good at blocking big guys to keep them from making the bad thing happen. The quarterback's going to get sacked. But other guys are kind of skinny and fast, aren't they? And they put them with other skinny and fast guys so they can all run together to make sure that the bad thing doesn't happen. Right? Okay? So we look for what? We look for fat controls to help fat things from happening. We look for skinny controls to keep skinny problems from happening, right? We try to line up the control properly with what? With the financial statement assertion that it's trying to protect. Okay? Okay, good. So, what I did here was I kind of put together, and I kind of adapted something that we used to use at GAO to assess the controls back in the olden days. Let's see if I can. Ha! Whoa! I'm supposed to do the Kung Fu grip to make it work. Let's see. Whoa! No? Okay. It's not going to let me make it any bigger, I guess. Okay. Well, I'll read it to you. It's a little hard to see from where you are, but I can't make it any bigger. Okay? So what happens? What we do is we look at an account, say sales. That says sales. Okay? And then when you look at your sales, you will look for an account that is related to sales. Okay? So what happens? If you credit sales, and it's a credit sale, you'll likely debit accounts receivable, right? So by auditing accounts receivable, I can get some coverage on sales, right? And vice versa. Okay? Then what? Then you say, what is the potential misstatement? Potential misstatement is what could go wrong. Didn't we say we're looking for what could go wrong? We're looking for what could go wrong. But notice, guys, when we think about what could go wrong, and by the way, this is one of the few times that accountants get to be creative. Okay, but when we think about what could go wrong, we think about it as relates to the assertion. Existence, occurrence is the assertion I'm doing here, right? And I would do this for completeness. I would do this for valuation allocation, because remember, different assertion, different audit procedure. All I'm doing on this example is existence. Occurrence, okay? But we will continue on with the other assertions. Now, the potential misstatement, Michael, is a sale and related receivables recorded, but the goods are not shipped. It didn't occur. They record the sale, they never ship the goods. That's bad, isn't it? That's a potential misstatement. Okay, that's the thing that could go wrong. Or the sales account is not properly adjusted for a return. So there's a return, and they don't take away the sale. They don't debit the sale. They don't credit the debit sale returns or whatever. They don't credit account receivable, right? They just leave the sale there. In either case, the sale did not occur, right? That's what could go wrong. Now, when I think about this potential misstatement, I am also required, remember they were saying that we should think about the business risk of the company as well. So I think about the business situation. In this particular situation, I'm saying that this company is in a competitive environment with very thin profit margins, etc. So there's going to be some motivation for them to overstate their sales, right? Okay. Now, I then try to find the control technique that will prevent or detect this bad thing from happening. And in this particular example, I say the individual that completed the sales order and submit the sales order follows up with the customer to confirm satisfaction of goods. You think about that. The same person that filled out the sale also is the one that calls the customer and says, hey, are you satisfied with those goods? Now what's going to happen? Maybe that person is getting a sales commission based on sales. And they don't want that sale to not be considered a valid sale, so they're going to be motivated to what? Say that a sale existed when in fact it did not, right? So this is where the auditor's judgment comes in, and the auditor uses professional skepticism and assesses risk. And I have assessed risk at high. The control is not effective. I don't like the design of this control. It is not sufficient to allow for a lower assessment of control risk. There is no separation between the preparation of the sales order and the control technique. Further, in walkthroughs, you will not only have to inquire about the controls, you will have to see that they have been implemented. And when you do that, we call that a walkthrough. Further, in walkthroughs, it appears that the control was not implemented because staff were not familiar with the procedures. I've been on walkthroughs where halfway through the walkthrough, you're showing the person, okay, let me do this for you because they don't know how to do the job. Okay? And that control is not implemented. So you can have a beautifully designed control, and if it's not implemented properly, it's no good. Okay? And then what? Further, the operating environment of the company is very competitive. Now, what will happen? First off, if we assess control risk at high, at the maximum, we're going to learn here in a little while that we will not have to test internal controls. You don't have to test them. You are not required to test ineffective controls. If the control is not designed and or not implemented properly, don't test ineffective control. It's a waste of time. You then go directly to your substantive testing. And in substantive testing, we're going to look to see that the dollar amounts between the financial statements are properly stated. And we will select an audit procedure that will help us with the dollar amounts associated with that assertion. So what are we going to do? We're going to confirm accounts receivable. We're going to select a sample of accounts receivable from the client's subsidiary ledger and send a letter out to say, do you owe $5,000? Do we have a good audit procedure for the existence assertion? You went to the financial statements, you send a letter out, right? Okay? Now, in this particular example, I went ahead and put next to this now, what would happen if we assessed our risk at low? So these are mutually exclusive examples, aren't they? Here it was high, here it's low. Same accounts, same assertion, same potential misstatement. But now what? For the control technique, I say sales manager follows up with the customer on sales orders prepared by staff to confirm satisfaction with goods. Now you say, well, John, confirming satisfaction with goods, that sounds like an operational thing. And it is, but it also can be used as an internal control for our financial statements because there's a potential that the customer will say, what? Tables. I didn't order any tables. We didn't get any tables. What? We didn't order any chairs. What chairs? We'll find out that the sale did not exist through that call, right? Okay? Okay, good. Then what? and confirms quantity shipped and enters on a sales call log. The manager signs off on the call log. The call log is forwarded to, there's our brethren auditors, the internal auditors. Then we say we can use some of the work that they do. Okay, so the internal auditors, it's forward there, and internal audit staff follow up monthly on a random sample of calls to reconfirm information entered on the log. Sounds pretty good, like they have some pretty good controls there over the existence assertion, don't they? Now, just because we like the design and we like the implementation does not end right there. So what do we have to do? The control is effective. The design is effective if the manager follows up on the sales made by staff and signs off on the call log. Further, there's good separation of duty added because the internal audit department follows up on the call and signs off on the call log. The internal audit department reports directly to the board of directors. Didn't we say we want to see that they report objectively to the right level of the organization? Okay, so we're looking at that. In walkthroughs, we observe calls being made by one manager who seemed to understand the process. Further, we observe the call being made by the internal audit staff and actually participated in some of the calls. You might get on the phone and say, hey, brethren auditor, internal auditor, do you mind if I make the next call? If I make the next call, you get on the phone and say, is that idiot auditor still here? Huh? I'm your customer. Talking about, right? Okay, so we do some work there, professional skepticism. Further, managers and board of directors members, we spoke to express concern about the competitive environment of the company and said that they believed that the controls were suitably designed for the company's operating environment. So we've got the board of directors involved. They're concerned. We've got internal auditors involved. We did walkthroughs. We liked the design. We saw that the controls were implemented, right? But even then, we have to test the operating effectiveness of the controls. What happens? Everybody's on their best behavior that day that you're there observing everything, right? So we want some evidence that those controls were operating properly throughout the year. So we would go ahead and select a random sample of sales invoices for the year and vouch these to the sales call log maintained by the internal audit staff, because there was supposed to be a follow-up call, wasn't there? And the internal audit staff maintained those logs. We look for the sign-off, and then by the manager in the internal audit department, we reviewed some internal audit staff reports to see if there was any concerns that were raised by the internal auditors about this control. And we discussed and identified internal audit report findings with the board of directors and saw corrective actions were made. Notice, guys, that what? We still do substantive testing, don't we? We still confirm accounts receivable, but what we're going to see is that as we get more and more satisfied with the controls, our substantive testing can decrease. When we do substantive testing and we're getting this evidence, remember external evidence is better than internal evidence, so we're sending confirmation, we're getting external evidence, aren't we? Those outside of the company could care less how efficient you are in your audit. Try it sometime. Send out a bunch of confirmations and see how many times you have to call and follow up and say, where's the confirmation? Please confirm that back and please get that back to us. Conversely, if you're what? Asking the company staff, can you please get me those call logs? They want to get you the hell out of there, don't they? So they're going to say, sure, you need anything else? You need a sandwich? So the more you can use internal evidence, because what? These internal controls are working better, even though it's not as reliable of evidence, it's okay if what? If we have the controls, right? So we're hoping for these two controls to allow us to be more efficient on the audit than having to go and resolve external data. But we still go and get what? Some external data, and the data is aimed at what? The assertion, isn't it? The correct procedure is all around this assertion. Okay? Any question about any of this? There's the same slide I had before. My favorite slide that does what? Lines up procedures with the assertions. The only thing, guys, I don't know if this is actually this is my favorite slide. This slide does what? It leaves out the internal control, doesn't it? It just takes you straight to the substantive procedure. Meanwhile, there's an intervening big 300-pound guy sitting there blocking these misstatements from hitting the financial statements, so we don't even mention in this particular slide, right? So it's really this way. It's this process. Okay? Okay. In determining whether transactions have been recorded, what assertion? In determining whether inventory has been included on the financial statement, has been recorded. What assertion is that? Completeness, isn't it? That's the completeness assertion. Don't we start with the source documents? Trying to make sure that an item has been recorded. That means it's been included in the financial statement. That's completeness. You start with the source documents, right? You were auditing a store that sells merchandise. Some of the store merchandise is held on consignment. Which account balance assertion for inventory would you be most concerned about if I'm doing what? I have things out on consignment. I want to make sure that it's included in my financial statements. If I'm holding stuff on consignment, I want to make sure that it is what? Excluded, don't I? So what assertion are we worried about here? Rights and obligations, stuff that's on my premises. Do I really have the right to it? Or does it actually belong to somebody else, right? Which of the following procedures would an auditor most likely perform to verify management's assertion of completeness? Take the what? The shipping documents, find the invoices, right? Something got shipped, there should have been a sale there. Okay. Observe the entity's distribution of payroll checks. That's going to what? Make sure that we have the appropriate individual receiving that check. So that's almost an internal control test. Okay. Confirm a sample of recorded receivables. That's what? That's the existence assertion, isn't it? Okay. Review standard bank confirmations for indication of kiting. That again is going to be what? Existence. We'll talk about cash next time. But kiting is where they try to include a dollar amount in two bank accounts at the same time. That's called kiting. Okay, and that's what? That's the existence assertion, right? And that's what you confirm. Confirmation is a classic existence assertion. Okay, observing distribution of payroll checks, I guess that's also existence, right? We have the payroll check. We look to see that there's somebody who's actually there that should have received that, right? That's existence. That's rights and obligations. Existence, kind of part, kind of cousin assertion. Okay, based on conversations with the owner-manager of an audit client, the auditor ascertained that the company's primary motivation is to avoid paying income taxes. Okay. Based on this motivation, which account balance assertion for ending inventory will the auditor be most concerned about? Now notice that I went ahead and I had what? Beginning inventory plus purchases gives us goods available for sale. And if they do what? If they understate their ending inventory, that'll make the cost of goods sold bigger, won't it? There's certain ending inventory items they don't count. That makes the cost of goods sold bigger. Cost of goods sold is bigger, then net income is going to be lower. Net income is lower. Taxes are lower, aren't they? So we're concerned about what? The completeness assertion as it relates to inventory. We want to make sure that inventory is complete because they're trying to understate their ending inventory so the cost of goods sold will be bigger. Okay, all right, guys, let's go ahead. Let's take a break right there. And, geez, I was hopeful that we were going to get through 2 chapters. I don't know. Okay, but let's go ahead and let's take a break and we'll come back and definitely wrap up chapter 3. Okay? at least get through chapter 3 here, despite my ambition to get through 2 chapters. So let's go ahead and talk about audit procedures. Okay? And we're going to see that we can group our procedures into 3 broad categories. Risk assessment procedures. Risk assessment procedures are where we look at the assertion, we look at the control technique, and make our assessment of our risks, the way we were seeing on that matrix that I had in that table for you earlier. We always have to do that. We have to do that on every engagement. Okay? Now, what that does is that helps us to determine, and you can really combine substantive procedures and tested controls and call that further audit procedures. Let me read that back to you because I know it's kind of hard to see. Further audit procedures are the combination of our test of controls and our substantive tests. Now, when you look, you say, well, John, you say sometimes on the test of controls, and so I can see how the assessing the risk will determine whether you're going to even do the test of controls. So remember, we said you do not have to test ineffective controls, right? But if we always have to do substantive testing, then how does our assessment of risk, which we must always do, tell us what further substantive procedure we're going to do? Well, remember, if the controls were what? Tested and they were operating effectively, then what? We didn't have to do as much substantive testing, right? Okay? So, we always have to make an assessment of our risk of material misstatement. We have to do that on every engagement. Then, to the extent that we test the controls, whether we do it or not, that's why that's sometimes, and how much substantive testing, we'll always do some amount of substantive testing, is determined by that first step, the risk assessment procedure. Okay? So, if you take a look at this next slide, we have our written audit program, and remember guys, we'll have our assertions, and we'll have what? We'll have our different audit procedures, and again, the internal controls are going to be in the middle there, right? So that one slide, the table that I put together, I think is a better way to think about all this, right? But if you take a look, we will do different audit procedures. We know how to test now completeness, we know how to test our existence, right? We talked about that. Other audit procedures include observation. Other audit procedures involve inquiry. Other audit procedures involve confirmation. As we say, confirmation is the classic step for existence, right? I'm going kind of faster, guys, because again, we're going to line up our what? Our procedures with the assertions as we go along. Okay, so I'm just sort of showing you the listing of procedures. The books like to always list the procedures in there. Meanwhile, they kind of forget to line them up with the assertions a lot of the time. Okay, the confirmation is classic for existence. Recalculation is good for accounting estimates. Probably should have left the word estimates in there. Remember, we said that what? Last time I had that triangle slide that said lead performance is really the best procedure for your tested controls. If you sit and you are involved in some of the calls, that was a pretty good control test that we did there, right? We actually got involved in some calls and kind of reperformed the control. Okay. Analytical procedures, scanning for unusual items to test. Okay. Now, when we talk about analytical procedures, guys, there are, what we're doing is we're testing relationships between financial and non-financial data and what's actually reported in the financial statement. Okay, we call these analytical procedures. Now, as you can see from this slide, we are required to do analytical procedures during planning. It is a high-level comparison that we do to shed any light on any account that's standing out as unusual. So remember that person with the big eyes was looking and was saying error, because they did an analytic and something stood out weird to them. Now we know we have to cast audit scrutiny on that. We're required to do that in the planning phase. We must do that in the planning phase. So we will compare last year's revenue to this year's revenue. And when we compare last year's revenue to this year's revenue, we see that there was a 100% increase in revenue during a period that the industry was suffering through a poor economy or something like that. Are you going to take a good look at that account? Something's not right. Why? All the rest of the industry is suffering and you're doubling your revenue. Now maybe there's a good explanation for that, but we're certainly going to what? Look closely at that. Okay? Now we are also required to do a set of analytics at the end of the engagement. What happens? Financial statements will not settle down. We are trying to audit them and they keep changing things and making adjustments. Financial statements don't just sit there and say, go ahead, audit me, I'm going to move. There's all kinds of things that are going on and we can't what? Risk that something weird slips in there at the 11th hour. So before we issue our report, our financial statements, we do what? Another round of analytics to make sure everything's where it's supposed to be. Okay, so these are both high-level sets of analytics that you do. Now, you can do a more detailed set of analytics as a substantive procedure if you want to. Okay, now you can read what I highlighted down here. Analytical procedures are most effective and most efficient for assertions in which potential misstatements are not apparent. What is that telling you? That's telling you that analytical procedure is not the most effective test. But it's okay if what? We don't expect errors and we have good internal controls, right? Then we can go to those less effective substantive procedures, for example, in analytics. Or for which detail is unavailable. In other words, you may want to do more detailed tests, but that detail may not be available for you. Okay? For example, I was on BART today, and I was 25 cents short of getting it. So I went to the machine and I had a $5 bill and put the $5 bill in, and then it's got a drop on the floor. Why? Why can't he just add that $5 to the figure? Why did it have to drop me on the floor? So, let's say you're auditing a laundromat. We're auditing a laundromat. And I want you to come up with an analytical procedure that we can use that'll help us audit washing machine revenue. Can you do the test of details on that? People are just coming up and dropping cash quarters. It's not even paper money. It's change that's being dropped into a machine. So it's not like there's going to be some invoices that come spitting out of there that you're going to be able to sit there and do a test of details and confirm and all that kind of stuff. Right? So can you come up, since there's not going to be the information allowed to do a test of details, we might have to go to substantive analytic here, right? Can you think of a substantive analytic? Can you wash laundry without water? At a laundromat. No, you need water, don't you? So how about we take the city water bill that says that this laundromat used 10,000 gallons of water. Now, I like using that water bill because it's external evidence coming in from a government entity, isn't it? Though it may not be coming direct. The client probably had the water bill first, but it's still external evidence, isn't it? Okay, so I sit here and they have 10,000 gallons. Now let's say that every load of laundry needs 2 gallons of water. Low water fee. Conceivable might be 2 gallons, right? So that means that we have what? 5,000 loads of laundry that should have been done. Now let's say, I don't know, but let's say they charge $3 per load. Okay? So the washing machine revenue should be what? $15,000, shouldn't it? 5,000 loads, $3, $15,000. Okay? Now, am I going to kill management if it's not exactly 15,000? No. I'm going to say, yeah, you know, plus or minus 20%. And you say, well, why 20%? Because that's what Yale uses for analytical procedures. We do plus or minus 20%. Okay? So it could be as high as what? 18,000, could be as low as 12,000. Okay? Now let's say it's $17,000 is the washing machine revenue. Is that a happy auditor or a sad auditor? That's a happy auditor because it fell within my expectations, didn't it? What happens if it's 33,000? Happy or sad? Well, neither. I am now an inquisitive auditor. His mouth is now, okay? Because we thought that, you know, you might be as high as 18. We would have hung, we thought you should be around 15. We would have hung with you to 18. You're up here at 33. And they say, wait a minute. Did you use the city water bill for your analysis? Manager says, yeah, we use the city water bill. Wait a minute. We have some clients that don't want their laundry washed by city water. They want rarefied water from the mountains to wash their clothes with, and we have to truck that water in. You didn't put that in your analysis? No, we were unaware of that. We then would do what? Probably switch to a more detailed test and ask to see those trucking bills and how much water got delivered, blah, blah, etc., right? So now we're going more to test the details when what? When our expectations weren't met based on our analytical procedures. Okay? Now again, we're obviously getting into what? A more disaggregated level. So what I'm describing to you is probably using an analytical procedure for a substantive test there. We are not required to do that. Okay? But sometimes the account just won't lend itself to a test of details, and so we switch to an analytical approach. Okay? Okay, good. Now, we talk about our risk assessment procedures, and as part of our risk assessment procedures, we will do those analytics which we are required to in the planning phase. We can use them as a substantive test, like what I described, if we want to, and then we always have to do that set of final. Okay? Notice, guys, we can use financial or non-financial data. Is a water bill, gallons of water, financial data? That's non-financial, isn't it? We could use things like the square footage of selling space or something like that. Financial or non-financial data is fine. Budgets make excellent. If your client has a standard costing system, it's going to give you excellent data for an analytical procedure, isn't it? I know you all love calculating, you know, direct materials variances, price variance, usage variance, direct labor efficiency variance, direct labor rate variance, and you're like, oh boy, I love those. Everybody loves those, right? Those kind of standard costing analysis are used by auditors every day. Okay? And there's expectation more and more that auditors use that data analytics not only for the financial statement purposes, but also to help management to better manage the company, right? Okay. Then what? Then we figure out a tolerable difference, plus or minus what? 20%. If it goes outside of that range, do we bill management? No, we do what? We get an explanation. If the explanation suits our purposes, we're good. If not, we're looking for, we keep going until we get an explanation, right? Okay, good. Which of the following are ordinarily designed to detect possible material monetary errors in the financial statements? Test of controls? No, that's what? The controls have operating effectiveness. Okay. Computer controls? Post-audit review of audit documents? That's probably a quality control step that the CPA firm will do. Remember our quality control steps? Okay. Analytical procedures? Yes. That could help us find monetary errors, couldn't it? Especially if we use it as a substantive procedure. An auditor's decision either to apply analytical procedures as substantive procedures or to perform tests of transaction account balances usually is determined by availability of data aggregated at a high level. No, that's what we do for planning, so we have to do that. Relative effectiveness and the efficiency of the test, is there going to be what? Data available that's going to allow us to do a more detailed test versus an analytical procedure? Okay. Timing of tests performed after the balance sheet date. Auditor's familiarity with industry trends. That might help us for our planning analytics. If you decided to use it as a substantive, it can depend on the relative effectiveness and efficiency of the test. Which of the following non-financial information would an auditor most likely consider performing analytical procedures during the planning phase? Turnover of personnel in the accounting department. Now, sometimes the students look at this and they're like, well, why not? Okay, remember, with an analytic, what we're trying to do is get a direct causal relationship between what's recorded in the financial statements and whatever data we're looking at, whether it be financial, in this case, non-financial, right? Water bill, washing machine revenue, perfect cause and effect, right? Okay. Can you come up with a cause and effect turnover in the personnel accounting department? For every 3 people that leave the accounting department, we get misstatement of 20%. Objectivity of the audit committee. Every time the audit committee loses 1 degree of objectivity, there's going to be this much misstatement in the financial statement. You can't make it like that. Management's plans to repurchase stock. Every time management sits and discusses the potential of buying treasury stock, there'll be this much misstatement in the financial statement. No. Square footage of selling space. Yeah, you've got what? You've got enough selling space to support a certain amount of sales, and if you're selling, Winnebagos, you see the Winnebago, you trailers, okay, then you need more selling space than if you're selling, computer chips, right? Okay, but there could be a cause and effect relationship. It's obvious. Okay, as a result of analytical procedures conducted during the planning phase, the independent auditor determined the gross profit percentage has declined 30% in the preceding year to 20% in the current year. The auditor should express an opinion that is qualified. Evaluate management performance is causing the decline, not our job. We are not there to assess management performance of keeping gross profit at a certain level. Require footnote disclosure. No, that's not required. Hey, here we go. The gross profit percentage change. Consider the possibility of an error in the financial statement. Yeah, that's our job, isn't it? Audit documentation. Okay, and when we look at audit documentation, the idea is that an experienced auditor should be able to come in behind you without any other input from you and be able to determine the nature of your procedure. You don't staple yourself to your workbench. They should be able to tell what you did just from the work that stands alone, right? Okay. Now, we can break our audit documentation into permanent files and current files. Permanent files are things that are going to carry forward year over year. For example, the articles of incorporation aren't going to change year over year. Okay? Information about board of directors, that's why that's going to change year over year. Okay? Current file relates to what? The current year. So the current year sales journal relates to the current year. Invoices for the current year relates to the current year. Now, these little numbers you see over here are work paper numbers, guys. And in this class, I do not get into, work paper numbering and that kind of thing. Every entity is different. These days, these are done largely electronically. Okay, we're not going to get ourselves all popped up and things like tick marks. Every textbook thinks that they have the standard set of tick marks. Meanwhile, every entity individually can say there are no standards. But that's just not the way. Okay? Retention rules are very specific. Okay? And we have them as they relate to the AICPA requirements versus the PCAOB requirements. Okay? And for SAS, okay, for non-issuers, PCAOB for issuers. SAS, we have 60 days to complete our audit documentation. 60 days. Okay, under PCAOB, it is 45 days. So notice they don't give us as much time for the public entities to complete our audit documentation. Any changes that are made after these thresholds, you have to leave the original in there. And if you want to make changes, you have to explain why you changed it. Within this window, you can tear out the old and bring in the new. Okay? Question? Okay, good. Computer processing. Okay, it's going to depend on a lot of things, the complexity of the organization, organizational structure, availability of data, use of CATs, computer-assisted audit techniques. Okay, not now CATs, okay, computer-assisted audit techniques. Need for specialized skills, etc. Okay. Now, some things that happen. You can have duties combined that you would expect to be separated in a manual environment. Why? Because computers don't order stereos for themselves and take them home. So you can have a system in which things are automatically ordered in a computerized system where you wouldn't expect that to be done, okay, in a manual environment. So how would you check the separation of duties if you had an automated environment? What separation of duties would you be interested in an automated environment? You might want to see what the rights are of individuals in the system. So we should separate what? Custody of an asset from record keeping. Right? So somebody can steal something, they can steal their theft by adjusting the accounting records. Okay? But in an automated environment, what accounting records, right? And so what you might do is look to see what the rights are of individuals in that system. And so does somebody have the right to update accounting records and release funds? Well, that would be what? Considered a competitive duty, even in an automated environment. That's how you would test separation of duties there. Disappearing audit trail. Okay, what happens? There will not be paper documentation. Okay, now another problem is that clients purge their automated systems frequently. I was on audit of the Bureau of Public Debt, and they use the Federal Reserve Bank to process their transactions. The Federal Reserve Banks purge their systems every 7 days. Why do they purge their systems every 7 days? To hide things from auditors? Why do they purge their systems every 7 days? Wipe out the data on the system. Erase the system every 7 days. Too many transactions. They can't store all that, right? So as an auditor, you would have to know that, right? And you start to make plans and, hey, can you save off certain data? Or maybe we're going to use some of these computer-assisted audit techniques that allow us to audit through the computer if we have a duplicated audit trail, right? Okay, good. Uniform transaction processing could be good in that it eliminates errors, but if there is a what? Logic problem in the software, then an error is amplified. Instead of affecting one transaction, it affects what? All of the transactions. So that can cut both ways. Okay. We could have a potential for computer-initiated transactions, potential for increased errors, opportunity for remote access, concentration of information. Once our system gets hacked into, they're into all the data, right? And they can do that remotely. Okay. If there is an error in the system, we may not observe that. Errors or fraud may occur in the design or maintenance of application. I was on an assignment where Congress wanted us to look at corporate credit unions. And what a corporate credit union does is it serves as a clearinghouse for smaller credit unions. And so what happens, you walk in there, and the day we walk in one of these corporate credit unions, and say, oh, we had a problem. We ran our backup and our maintenance on our system at the same time. So instead of running the backup and then running the maintenance, we tried to run them simultaneously, and they crashed the system, they corrupted the system, and it was down for like 2 or 3 days. Which is a big problem when you have all these smaller credit unions feeding into one big credit union, so people weren't getting their checks and everything else. It was a big problem for a couple of days. Now, what was interesting about that one is you said, well, what was the cost of that? And they said, oh, we don't know. We didn't track the cost of that. So when we took the tour of the facility, looking for really professional skepticism, I saw written on the board, ACH outage and a job code next to that. And then we got that to the. By the way, what was that job code for ACH outage? Oh, well, you know, we've been tracking our time that we've been taking, and we'll get you a number of the costs. So they were able to come up with a number of what it cost them because they weren't using proper maintenance, right? Okay. Another area, computer disruption may cause errors recording transactions. Well, that's a classic example right there. Okay. I was on another assignment where Congress had us looking at what happens when you have to pay your taxes. You have to pay it. Have you ever noticed where that tax return goes? You have a tax return. Where does the tax return go when you file Satan himself. When the client asks us, hey, where's the tax? What city is it? Where's the tax return go when the client gets a refund? When it gets a refund, the tax return goes to Fresno. Maybe some of your clients come from Utah. Either goes to Utah or Fresno. Those are two IRS service centers. Been to both of them. Neither of them are most to write home about. Auditors got treated now. Fresno, you go and you process, we look at the tax return in Fresno because we're auditing on the government's revenue, right? So I have a revenue cycle, so we look at the tax return. Okay? So when the client puts on there, this is your tax liability, well, we look at that number for revenue to the government. You go to Fresno, and you have to get up there to go with the property of the $500 in Fresno. And it's the fertilizer you put. Ogden used to use that. I don't like you. So, where does the tax return go if you look at the code? It goes to a PO box in San Francisco. And in that PO box in San Francisco, it gets on a truck, it goes down Highway 101, it crosses the San Mateo Bridge into the greatest city in the world, which is Hayward. It goes into Hayward. It goes to Hayward from there, and it gets processed in Hayward. And now, what happened was some of the they call that a lockbox service. Some of the lockboxes with the private banks were shredding the tax returns. They couldn't keep up with their quota, so they were taking the tax returns which contained checks that were headed for the U.S. Treasury and just shredding them because they couldn't keep up with the quota. So when IRS came in to look to see if they're keeping up with the quota, they didn't see a bunch of tax returns laying around and said, okay, you're doing good. Meanwhile, taxpayers pretty soon were saying, hey, how come you never cash my check? Does Congress think it's funny when checks headed for the Treasury are shredded? They were none to use. So when these came out, they said, yeah, you better go look. So I get stuck on this assignment. IRS, the lockbox in Hayward, and I speak Hayward. So I need to go to Hayward to review this thing. So they were doing all kinds of weird procedures. You had some going in this first, and see if they could walk in to the service center and lockbox with their purse because it was supposed to be everything sat there and stuff like that. As an auditor, you should never become part of the problem. Okay? But in talking to them, what we found out was that they had their main system in Hayward and the backup was in San Francisco. What's the problem with that? One event could take out the main and the backup, couldn't it? Okay, so I told those guys, I said, look, you're going to have to move that backup. You cannot have that backup in San Francisco. I'm telling you right now. That's going to be a problem. Before we finished the audit, they moved it. They said, by the way, if you move that, we're moving the backup to Texas so that we're not on the same grid. So you look for what? You look for these kind of things, computer disruptions that may cause delays, problems in recording transactions. Now, what we just described is a general control. And we tell you that specific application controls are only as valuable as the general controls that they rely on. General controls are things like disaster recovery. General controls are things like passwords. So if you can hack into a system then who cares what particular application control you have, say, on the payroll? Because someone can simply hack in and say, well, from John Lord, maybe the limit on paycheck is 10,000, but for Lord it's 100,000, right? Because I can hack in and override the application control. Okay? Okay, good. So you have your general controls. General controls are things like what? Things like disaster recovery, network operations, system software acquisition, access security controls. Application controls are controls over what? Over maintaining, reviewing account balances, that sort of things, for example, your payroll. Okay? And again, if the general controls are shot, I don't care about the application controls. You can have manual controls. Manual controls are good for unusual, large transactions. Automated controls would probably be better for what? Higher volume, recurring transactions. Okay? All right, let's go ahead and let's go through these computer-assisted audit techniques. Now, what happens here? This is a situation where you have a client that has a highly automated system. You're going to have that disappearing audit trail. And so what you would use are these computer-assisted audit techniques that help you to audit through the computer. For example, transaction tagging. Transaction tagging, you're going to put an electronic mark or tag on a transaction and be able to follow it through the client system to see if it processes correctly. You could also have embedded audit module. Embedded audit module will save off transactions that meet certain criteria. So the client tells you, well, any expense in excess of $500 should be capitalized. Well, that's great. Put in the what? Repairs and maintenance account, something that will do what? Save off every transaction in excess of 500, and so if it ends up in repair and maintenance expense, you can sit there and say, well, I thought this should have been capitalized, right? Okay. Integrated test facility. With an integrated, oh, well, let's go in order here. Test data, okay? With test data, what basically we do is we're going to put in dummy data in which the results are already known. And we will do that offline on the weekend or something like that. Now we do that because our client does not want us to mix dummy data with live data. So we'll put through a set of dummy transactions. We know how it should process, and we'll check to see if it actually processed the way we think it should have. But we do that offline. We do that offline because what? Clients afraid we're going to collect and disrupt their system in the middle of the week or something. Right? So maybe we'll do it on the weekend. Okay? That is different than integrated test facility. Okay? With an integrated test facility, now what? Now we will go ahead and commingle the dummy data with the real data, and now this gives us an opportunity to see what? See how our client personnel interact with that data. Better test, isn't it? But your client would say, you're not crashing the system during the week. So you'd have to do something if you were using the test data to make sure that you're satisfied with how the interaction happens with the client staff, right? Okay? And then parallel simulation is a computer-assisted audit technique in which we will take the client data and run it through a system or a program that is controlled by the auditor. And we're going to look to see what? The auditor system processed the data the same way the client system did, gives us some satisfaction the client is processing that, client system is processing that data correctly. Okay? These are all computer-assisted audit techniques. I think you can get the sense that we don't need all of that documentation to get a satisfaction that the client system is processing the data correctly. Right? Okay. Any interest in doing this kind of work? CPA firms would love to have you. This is something that is in demand, people that can go in and do these kind of penetration testing of the general controls, use these computer sets audit techniques, that sort of thing. So if you think you've got any interest in there, I would encourage you to consider that. And we, GAO, what we do is we contract with PwC to do a lot of that work for us on the communication. Life opportunities. Okay? All right, let's take a look at a couple of these. Which of the following computer-assisted audit techniques allows fictitious and real transactions to be processed together? Integrated test facility, I mean, it's almost telling you, integrated, fictitious and real. Okay, good. Which of the following computer-assisted auditing technique processes client input data on a controlled program under the auditor's control? The parallel simulation, right? Okay, good. So you look at these descriptions, I mean, the titles are very descriptive, right? What's going on with these? We're going to stop there. I didn't even make it constructive. We're going to stop there because it's going to take us too long to do the reality. We want to rush through it. I think it's a little bit, yeah. Okay. So we're going to stop there. We'll pick up here next time. Okay. We'll go through the quiz and the homework for chapter 3. We'll get chapter 4. I'm going to stop line. So we'll definitely get through chapter 3. Okay? All right, guys. Have a good rest of the week. I will see you on Tuesday next week, all right? You can probably start to look at the homework and the quiz questions, by the way. The materiality ones you might want to skip, but the other ones you should be able to look at. And we'll hit those next time.